Welcome back to Squawk Box. Well, the shakeout in the commodities market continues. Take a look at this. The CRB index, which tracks 19 commodity futures, was down by 3%. Let's also not forget that in the latest move by the CME, they have raised the margin limits on gasoline. That probably explains why we saw such bloodletting in the gasoline market and the futures in New York. At one point, it hit its downside daily limit. The circuit breakers kicked in and trade was stopped. The first time that happened since the depth of the crisis back in 2008. So the bearish catalysts that led to this overall decline in the commodities market was threefold. You had a perfect storm, if you will. It was higher gasoline inventories. I guess the CME margin requirements did the trick as well. Slowing industrial growth in China. On top of that, for the grains market, we got news of global supplies improving. Let's get a bit more analysis and visibility on where these turbulent and volatile markets are heading. Owen Hegarty is Vice Chairman of G Resources Group and joins us here at the SGX for some more analysis. Owen, this shakeout just continues. How do you trade these volatile markets? What I hear time and time again is that the bull cycle is intact. Is it?
Well, you do have volatility. That's one thing you're going to continue to have, Sri. That is for sure in this type of market. When there's not full recovery yet from the global financial crisis, you've still got strong demand. You've still got a very subdued supply response going on there. So under those circumstances, you're going to have volatility. That's for sure. So it's a question of watching them very closely. But my view and our view, very clear that you've still got good, strong underlying strength in demand, and the supply response has been subdued, and that's what's giving you this sort of volatility.
The new normal, though, Owen, really seems to be this new dimension of regulatory uncertainty. We have higher margin requirements placed on silver, now crude oil, and now gasoline and possibly grains next. Is that helping to shake out some of this speculative fervour in the markets?
Look, I think there's, as you described, there's a bit of a shakeout going on, if you like, and take silver, for example. I mean, silver popped up there to north of $40, up to around $50, that sort of level. It sort of doubled in a few weeks or a few months, so that was really a speculative bubble. The long-term relationship between silver and gold is about 60 or 70, something like that, which implies a silver price at today's gold price of closer to the $30 area, which is, you know, and it's slipping back to that sort of zone at this time. So if you take that sort of ratio, that long-term ratio, then that's about the right price from that metric. Silver, of course, it's a different metal to gold. You know, the market's a bit less, therefore not as liquid, and it comes from different sources, type of thing. And it's an industrial metal as well as a precious metal. So there's quite a bit of substitution going on there. So it's not exactly the same factors as gold.
Yeah, Karen and I and Sri, we've been talking this morning about the Raj Rajaratnam case, hedge fund insider trading. 14 counts, convicted all, up to 20 years in prison. The thing is, though, I mean, there's a lot of spec money in commodities. We know that. We always talk about that sort of premium. And we've seen hedge funds already starting to self-police themselves ahead of this verdict. What about now? What's going to happen?
Well, what tends to happen, of course, when you see the hedge funds getting into trouble, and they will always get into trouble when you've got this sort of volatility, because they're taking positions all the time and just too hard to sort of outguess, beat the market under those circumstances. You tend to see those positions become somewhat public, so that's interesting in itself. Okay. And of course, there's a lot of positions got to be unwound. So there's speculative activity going on there, and you see the unwinding of those positions.
Equals more selling in commos ahead,
well,
potentially?
There's positions going both ways, so right. So they'll be unwound in both cases. So they'll be, that's right, getting out of there. How do you trade it with this sort of volatility? Which you're getting back to the original question. Well, some of the best things, I mean, if you're going to trade the indices or you're going to trade the metals and so on themselves, that's one thing. You've got to be pretty good at it to be able to do that. But from a medium-term investor, medium-term trader, longer-term investor, the best way to do it, in my view, of course, is the equities market, and that's, you know, you've got to look for those for the companies that have got good, strong assets, good positions, good resource bases, good background, good credibility, good record, those sort of companies, and with good prospects and projects, and in my view, obviously, in this part of the world, in the Asia, Australia, Pacific area, that's where the growth is coming from.
Speaking of which, before we let you go, can you give us an idea of the demand story playing out in China? We saw industrial output coming in at 13.4% yesterday. What do you make of what China's doing behind the scenes with key commodities?
Well, look, you've still got that same strong underlying demand for commodities in China. It's driven by the high growth rate. It's driven by the urbanisation. It's driven by the infrastructure development, and it is at a very high intensity for commodities, part of their economic growth cycle, if you like. So they're at that sort of level. So you've got the underlying strength in demand, and you've also got a sort of social and political imperative to ensure that that keeps going. And under those circumstances, you'll have that strong demand. You will always see bubbles and humps and bumps and so on along the way here, but you've got that strong demand. We, in the supply side, the companies supplying that, have to catch up. And we have to continue to develop our projects, find more projects, find more ore bodies to continue to deliver into that market. So, yes, you'll see some humps and bumps and some blips along the way here, but the underlying strength is there. And then not only do you have multi-decade sort of growth
in other words, the supercycle lives on, right? Supercycle lives on.
Yes, absolutely.
Okay.
The supercycle is there, and China, India, and the rest of the developing world all revving their engines, ready to get on that super highway of growth.
All right. Owen, listen, always great to talk to you. Thanks for dropping by.
Thank you, Mark.
See you again soon. Owen Hegarty there around the desk with us here at the SGS.